Hi everyone, welcome to this webinar brought to you by Bursa Malaysia and managed by Lifecharm. I'm Atira and I'll be your moderator for today's session. So, our topic for tonight's webinar is about deep dive into Malaysian real estate investment trust, REITs. Want to invest in a property without the stress of managing it yourself? That's where Malaysian REITs come in. They let you in invest in the real estate just like buying stocks, easy and flexible. As the Malaysian cities grow and infrastructure improve, REITs are becoming more popular, especially in retail, office, and industrial space. Plus, they often pay attractive dividends. So, how can you make the most of these opportunities? We are really honored to have the founder of Want to Invest, Mr. Maxton, with us today. He will share how to spot a good rates investment, understand market trends, and build a smart strategy, even if you are just getting started. Before we are going further, allow me to make a short disclaimer. Please be reminded that everything that is shared in this session is mainly for educational purpose and by no way we are providing you advice to buy and sell any securities. You are 100% liable if you make any investment decision. Now, I would like to briefly introduce our esteemed speaker for today. He is none other than Mr. Maxton. Mr. Maxton started his journey in the capital market by first indulging himself in the SME financing industry after finishing his diploma in finance and investment in TAR-UMT. And he had quickly moved on to participating organizations such as Rakuten Trade and TA Securities, taking up different roles, including risk and compliance officer as well as dealer representative. Today, Mr. Maxton had just passed the 8 years mark in the capital market as an investor himself, where he also had the opportunity to run the big financial blog, Want to Invest, with over 16,000 followers since 2019. Mr. Maxton also the associate director for a private equity firm, Sanseria Capitals in Neighborhood. Currently, Mr. Max also a SGX Academy speaker. With that being said, let us warmly welcome Mr. Maxton to the floor. Good evening, Mr. Maxton. How are you today? I
Hi,
hope
good
you are doing
evening.
well.
Good evening, Atira.
Yes.
And good evening, everyone. I'm doing fine. Thank you.
So I will pass this to you, okay?
Sure. Thank you so much for the kind introduction. Good evening again, ladies and gentlemen. Just give me a moment. I share my screen and there we go. Okay. Okay. Once again, thank you everyone for joining the session today. As Atira has introduced just now, today's session is all going to be talking about Malaysian real estate investment trusts or what we call REITs, right? And just to see anyone is same like me, you love to receive rental income or you love dividend, right? If you love dividend, you can comment dividend, or if you love rental income, you can just comment rental, or you can just comment income, right? Just to see if we are on the same channel today. All right. Okay, fantastic. Thank you, everyone. Thank you, God Leong, Tian Ming, Joshua, Evelyn, Fitri. Fitri said both. Okay. Only kids make choices, right? Exactly. And Alex said dividend. Okay. A lot of you replied. Thank you so much. And personally, I love dividend and I'm a long-term dividend investor. And dividend is something that if you're new to investing, dividend is basically something that is safer in the nature and as compared to growth stocks, I think relatively speaking is safer, and it is something more suitable for people who are risk averse, and is more suitable to people who have less time to focus on trading. Maybe you're too busy with work, you're too busy with your family, etc. Right? So it's a very good vehicle for those who love dividend and passive investing. So as we go through the session today, I'm gonna need everyone's help on two things. Number one is that by the end of this session, we are going to, if we have the luxury of time, we're going to try to analyze and dissect one REIT. So everyone, if you have your favorite Malaysia REIT, so comment in the comment box below. So later on, we'll try to look at it. And if you have any question, I've been warned by the moderator, please leave your question in the Q&A box so that we can pick your questions out of it. If you leave it in the chat box, probably we might miss it. Okay, so without further ado, let's jump into our topic today. Disclaimer, as Atira has mentioned, today's session is only for information and also for educational purposes only. It should not be any form of investment advice. So after the session, if you really need any form of investment advice or guidance, I would strongly recommend you to seek for an licensed investment analyst or your dealer representative to advise you accordingly. Okay, gonna skip this part. And okay, just to see the understanding of the our audience today, right? How many of you, this is the first time ever you saw the word REIT? Apart from you registering for the webinar, of course. How many of you do not know what is REIT? If you know REIT already, you can go to the emoji and put a thumbs up. But if you have not touched or you have not seen REITs yet, you do not know what exactly is REIT, you can comment and no. Okay, just want to see so I can adjust whatever my content sharing later on. Okay, we have Bell. Okay, most of you are putting thumbs up. Thank you very much. And thank you, Bell and Xin in okay, thank you everyone for your comment. I'll try to make it more beginner friendly for everyone here, right? The objective of the session today is for everyone here to understand what exactly is a Malaysia REIT. And the key takeaways from today is why Malaysia REIT exactly, and what are the types of Malaysia REIT is actually very close to us day to day, and how we as investor, how can we study Malaysia REITs? Okay. Now, the concept of REIT is really, 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 really simple. Okay. So this is a mall. We all love, as a Malaysian, we all love going to malls on weekend and whatnot, especially today. There's just an announcement where everyone above 18 years old, we get 100 ringgit, right? So it's very simple. Imagine if you are an investor, you want to own a parcel or you want to own a part of KLCC or you want to own a part of Pavilion Kuala Lumpur. Can you afford it? Personally, I cannot, but if you can, feel free to comment yes in the comment box. But what happens when you like a property and you would like to own a part of it? Of course, when the price is right, right? This is where REITs comes in. Okay. So imagine a property like KLCC or Pavilion or even Mid Valley. Just imagine it being a huge piece of cake, and everyone here wants a bite out of it, right? But this cake obviously is too expensive. So all of us here, we pool a lump sum of money, we pool a lot of money, then we buy the cake, we buy the property together, and then we share whatever we get a bite out of the cake basically. And in terms of property, everyone gets a share of proportionate to how much money you paid for the cake exactly, right? To a lot of people have been saying, asking, oh, can I start investing with 100 ringgit, 50 ringgit or whatnot? For REITs, if you have 100 ringgit, yes, you can start owning a parcel of, Pavilion up. Pavilion probably you need 170 ringgit or 180 ringgit. But with as low as 100 ringgit, you can actually start owning a very small bit of a property. That's the beauty of REIT. You get a sharing from whatever rental income that generated from the real estate itself, and ultimately it goes to you, which we are the investor or we are the unit holders per se, right? And one thing that I would like to emphasize is that the beauty of REITs exactly is everyone can just start investing in REIT now, as low as 100 ringgit, as I mentioned just now. And if you all look at the biggest thing in investing, the biggest thing that could help you over the long term is that the compounding effect. So remember that Warren Buffett mentioned that the seventh wonder in the world is compounding. So if you just start investing now, the best day to invest is actually yesterday, right? As we all say. But if you are new to REIT itself and you like properties, plus you like liquidity, I'll talk about liquidity a bit later on, right? So you like to get a share out of Pavilion, you like to get a share out of KLCC, their rental income. I think you should look into REIT. It's a very fantastic vehicle. And again, as I mentioned at the very beginning of the session, it's suitable for people who do not have time to look at the stock market day in, day out. But the downside of REIT is that you cannot choose the ingredient of the cake, right? If the cake is a carrot cake, you cannot say, I want to put chocolate inside. Let me give you an example. If you look at Pavilion REIT, everyone here, I assume you know Pavilion, right? If you're living in Malaysia, you like Pavilion Kuala Lumpur, and you like Elite Pavilion Mall, which is next to Pavilion Kuala Lumpur. And um, but when you buy Pavilion REIT itself, it doesn't just own Pavilion Kuala Lumpur, and also it doesn't just own Elite Pavilion Mall. It also owns other mall. For example, like Pavilion Bukit Jalil, they just acquired two assets, which is one of it is adjacent to Pavilion Kuala Lumpur, which is the Pavilion Hotel, Banyan Tree. So they just bought additional assets. These assets, you can take it as whether you want to take it at icing or you want to take it at layers or ingredients. I would call it ingredients. They are the ingredients of the cake. You cannot choose them. When they serve you the cake, right? They serve you everything together. They have hotel, they have their Pavilion Tower, which is a commercial property, like an office. And they also have different kind of shopping malls, including the Pavilion Bukit Jalil, which they just acquired not too long ago. Now, in these ingredients, there are times that there are ingredients that you don't like. Maybe you're allergic to it. But in this case, don't worry, the allergic won't kill you. You just don't like it, right? The ingredients, like what I mentioned just now for Pavilion REIT as an example, it also includes a mall called Damen Mall. I'm not sure if you guys in PJ probably passed by before Damen, right? And if you look at their recent performance of this particular mall, it's underperforming when compared to Pavilion REIT other assets. But there's nothing perfect in the world. There are ups and downs. Other assets for the Pavilion REIT is performing, except for this particular asset at the moment. So just for your context, when you're buying into a REIT, there are times that you cannot, or I should say, most of the time, you cannot choose what are the ingredients inside. In other sense, you are relying on the REIT manager. REIT manager means the person that are managing day in, day out of the property, and also the ultimate decision maker on what kind of ingredients they want to put inside the cake. For example, they want to put funny ingredient. You're making a chocolate cake, suddenly you want to add orange. Maybe it tastes good, maybe it does not, right? So to put it into context of REITs is that um, there are times that this kind of REIT, they will buy some assets you think it doesn't make sense. So how do you define whether the acquisition makes sense or not? We'll talk about that later on, right? And uh, regardless, when you buy into a REIT, right, you can still taste the cake in the sense that they would need to pay out 90% of their distributable income to you. So unlike if you buy a stock, if the management or the board don't feel like it, there are some stock on every single exchange that the family member refuses or they don't like to pay dividend. But for REIT, the net distributable income, they have to distribute 90% to you. So in the context of cash flow and also dividend, like a lot of you love dividend, including myself, you will receive almost for guarantee a distributable income, unless when the property or the REIT is making losses. So one of the benefit of it is after you buy, you can just basically just sit back, relax, and convince if it's a mall like the photo over here, just convince your friends to go and shop at the mall you just purchase or co-own, right? If it's a retail REIT. So basically, that is the concept of REIT itself. You own a part of a group of assets, right? And you get a sharing out of it, the rental income, and also when they do exhibitions. In REITs, there are different kind of REITs in retail, right? Just for your information, sometimes they may have a fixed rate. For example, there's a fixed rental every month. But most of the retail malls nowadays, if they are good quality malls, they will request a share of the revenue or the share of profit of it. Okay, whichever is higher, of course. So when the market is good, when people are spending power, normally this kind of retail rate, they will also perform better. So it's not just fixed kind of return, just for your context. And also parking income also contribute quite a lot to retail kind of assets, right? Okay, and let's do a quick check, right? What do you think, based on what I explained just now, what do you think are the key criteria for REIT to become a REIT? Okay, what do you think are the criteria apart from what I just mentioned just now? Okay, the first and most important thing is that the REIT, which is if you spell it REIT, real estate, the main asset composition should be real estate. And according to the guidelines of REIT, they must stay invested in 75% of their total asset in real estate or properties. Okay, that means that when you buy into a REIT, it's a listed vehicle, but they must invest 75 or they totally own, let's say 100 million, 75 million of it must be real estate. Otherwise, a lot of people, not to say a lot of people, there are people that might use this vehicle, but they go and do other things. So it's not really generating cash flow or rental income for the investor itself, right? So following the guideline, 70% of their asset must be in real estate or properties. And then the balance 25%, they could hold securities or other liquid asset subjected to approval. And a lot of people may not know, but they can actually own a maximum of 10% on new development projects. But it's very rare in Malaysia, very, very rare. Why? It's because most of the REITs in Malaysia, they are either residential or they are in industrial or they are in office REIT itself. So it's very rare case that a real estate they actually own a part of a new development, because just imagine when a developer they develop a new um, warehouse, yes, a REIT can participate, but so far we don't really see that a lot. In fact, as a matter of fact, in Malaysia now, a lot of new developments they are actually residential in nature, which are the house that we live in, and we do not have a residential REIT per se that caters for this kind of asset, right? We have a hospitality REIT, which is mainly doing hotel, YTL hospitality REIT, but that one is not on residential specifically. Okay, and next thing is I want to emphasize back to the REIT is that behind a REIT, there's usually someone called sponsor. It's not that they sponsor you to get free properties, but it's just a technical term to call sponsor, right? These sponsor are the people that are supporting the pipeline of acquisition. So in the context of cake or um in what we explained just now in terms of a cake, these are the people that will propose to unit holders, the investors, different kind of ingredient. Hey, do you want to buy this ingredient? Do you want to buy this or this ingredient? They will propose to you from time to time, depending on what kind of assets they have. So it's very important to see who is the sponsor for REIT behind the REIT. We'll talk about this also later on because this one is a bit technical. Don't want to confuse some of you who are new to REIT first. Okay. Now, for a REIT, as I mentioned just now, in order why they have to pay out 90% to you, as I mentioned just now, can't they just keep the money? Maybe I keep 50% of my money, I just pay out 50% to you, and the balance 50%, whenever I like it, I just go and buy new property, I go and buy new asset. In Malaysia, the REITs are mandated to pay out 90% of their income to enjoy a tax exemption. Now, to clarify, if you have invested in REIT before, you'll notice that there are two different kind of REIT, I mean the distribution, okay? So give me a moment, I try to show you guys. Okay, let's look at, okay, I saw someone mention X REIT, but okay. Just give me a moment, guys. Okay, let me share another screen. Okay, if you look over here on this part, you will notice that they actually have two different kind of dividend, right? Just for explanation, in terms of distribution, we call distribution for REITs, right? When it comes to REITs, there is a 10% withholding tax, but you don't have to worry about it because they will deduct it and they will pass on the net sum over to you as an investor, right? So you don't have to worry about, I need to declare tax, I need to do all these things, whatnot. No, they will issue the net sum over to you, right? But you are still subjected to the 10% withholding tax. So some of you who just started investing in REITs, you will notice that why is the total amount that I receive and the declared distribution per unit, which we will call DPU, is a bit different. It's because part of it is tax exempted, but another part of it is actually subjected to the 10% withholding tax, right? So the net sum is usually we deduct by 10% is your net distribution yield. Okay. Right. And another question you might have is that if you look into last year, we have a regulation or we have a new guideline. If you receive over 200,000 uh, in annual dividend, you will be taxed by 2%, right? But for distribution from real estate investment trust, basically you are exempted from this one. Okay, so if you are a hidden rich guy that you are hiding in the comment, so rest assured your REIT investment will not be subjected another 2% tax. So that's the 10% withholding tax that you will be subjected to. Okay, and next thing, if you are a property investor, probably you are also aware of another quite critical factor, which is the gearing. Gearing means the level of debt of a particular REIT itself, right? The formula is what the total debt divided by the total asset of a REIT. So according to the guidelines, it needs to be below 50%. When I have 1 ringgit of total asset, my total debt level should be 50 cents only. This is to protect investors in the event something happen, so that at least when the property price, is not exactly liquid properties. Yeah, REIT itself is liquid. But when you want to dispose the ingredients, which are the properties inside a REIT, is not so liquid. You need to give discount to sell it off immediately, just like your lelong, right? So they have a certain what we call a margin of safety to protect investors, which the limitation of gearing ratio for REITs is 50%. But during the COVID-19 era, actually they allow up to 60% due to their asset pricing adjustment. For example, when during the COVID times, a lot of pricing of properties has also been adjusted downwards, right? And when your total asset goes down, assuming your debt level doesn't go down, banks wouldn't just say, "Oh, COVID, let me give you a discount on your debt." Never happened. And imagine when your asset go down and your gearing ratio, you are at 49% before COVID-19. But after COVID-19 and the asset repricing, you actually went up because of your asset gone down, right? You passed the 50%. So at the time, actually REITs, Malaysian REITs are allowed up to 60% for a short period of time. But that one is one-off case. Usually we are at 50% at the current moment. Okay. And also this limitation of gearing is also to protect investors in the sense that it prevents a REIT to go overly aggressive in acquiring assets, right? If without this gearing, a lot of REITs, they will keep fundraising, buying properties, fundraising and buying properties. But with this limitation, hard limitation, they will need to think very carefully whether they want to raise capital, which increase their gearing ratio to buy a property, right? If they buy a wrong property, immediately their gearing ratio will spike up because of the price adjustment. Okay. And the next factor that what makes a REIT is that they are listed on exchange. This is very, very um, important. So basically, the liquidity of a REIT comes from it being listed on an exchange, which means you can buy and sell tomorrow starting from 9 a.m. up to 5 p.m. Actually 4:45, but 9 a.m. to 4:45 or 5 p.m., right? And after T plus two, which is one day on the day you sell, plus 2 working day, basically you get your investment back. Now, remember, let's compare this in the sense of you buying an actual property. Do you think you can receive the fund in 3 days? I don't think so. Okay, so it's very important that it is listed on exchange and is being liquid. And another thing, this is something extra, is that I noticed that in the market there are more and more different kind of investment schemes that are coming out that claiming they are REITs. If they are not listed and they are not being registered as a REIT with Securities Commission or Bursa Malaysia, so most likely that's not a REIT, that's just a holding vehicle. So you have to be very careful with them, although there are assets inside, right? So liquidity is very, very important in a REIT. Okay. Now, before I go to the next slide, actually I want to focus a bit more back on the gearing pointer because it is interchangeable with the last pointer, which is listed on the exchange. What are the main benefits that a company or a vehicle gone for listing? Is the access to additional capital. Now, before a company go to listing, 90% of the time, if they want money, who can they talk to? Banks usually. And banks would give you a loan, which what we call financing, right? But when you are a listed vehicle, you can ask for equity financing, which means I would dilute my shareholdings or I dilute the existing shareholders to get a fresh sum. This is what we call whether a private placement or whether it's a right issue, right? And if you look at a lot of public listed companies in Malaysia, there is a mandate or there's a resolution that mentioned that every year they can issue a 10% private placement approval during their AGM, right? So you can check and see whether when you receive the notice for AGM, whether there's this specific resolution inside there. In the context of REIT, it means for every year they can issue new 10% of shares to raise fund to prepare to buy properties. So in the context of cake, again, it means that they would reduce the size of cake given to everyone because you have been diluted. They are raising fresh capital, but the total size of the cake might increase. Just that the sharing you get might be lesser, subjected to what kind of properties they are buying or what they do with the money. Okay, don't worry about that. We will give you case studies or examples later on as we progress. Okay, but usually when a REIT it when they do too much fundraising, especially equity fundraising, it could upset investors. So I believe there are some seasoned investors here. You hate private placement because it dilutes your EPS, it dilutes your DPS. Basically, it means that more people come and share your pile of the cake. Of course, as a beneficiary, I got fed up if you keep doing this and non-stop. Unless the cake got bigger, although there are more people coming in, the part of the sharing I get remains the same. Then that is a different story, which is the example we'll be talking later. Okay. Now, this is a comparison table between traditional real estate and also REITs itself. Okay. So some of you might ask me which one is better, but I would say there are no clear winners. As someone in the chat box mentioned just now, we want both. Why not both, right? So only kids go and choose. I want both. This is the case where you can choose both if you wish to. So let's go through the pointers one by one. Now, first of all, if you invest in a traditional real estate, I believe you know you have the direct access to the property, which means you own the whole piece of cake. But unless you are paying full cash, which if you're ordinary person is very unlikely, right? That means that it comes with a liability. You are taking up a bank financing in order to buy the property or to buy the cake, right? In a contrast, let me give you an example. We are going to dive into a bit more numbers driven. Now, in contrast, if you are using 5,000 ringgit, is usually I think it's insufficient for down payment, because a 10% down payment for, let's say, a 300,000 property, right, is 30,000, unless you're buying a subsale, which is a second-hand, what we call second-hand property, right, which they do not have cashback. But usually if you buy new projects now, developers, they'll push maybe 11%, 12% cashback for you and whatnot. So if you only have 5,000, you compare the two, 5,000 may be more viable if you are looking into REITs in terms of the capital. But some properties investor, they might argue that, okay, I'll give you another example. If I have 10,000, right, that I can invest in a 300,000 property, assuming this is a new project, the developer provides me with financing and everything, fantastic, right? I got cash back, so I do not need to fork up with 30,000 as the 10% down payment. And then it went up to 400,000 in 5 years' time, which is the period that RPGT, real property gain tax, has passed. So there are no tax on my property. Then your 10,000, effectively, it earns you 100,000 in a capital gain. So it's a 10 times return on investment. But if you look at the house pricing by NAPIC, which is the national agency that provides you the property data, NAPIC, the property prices for the past 20 years has actually peaked in 2012, and then it went downwards all the way until 2021, and it just started to see a rebound. Okay, for example, in 2024, we see a 4% rebound year on year. And back to the case study just now, when you have the 10,000, you have to make sure this property has to be cash flow positive, which means whatever amount that you rent it out is higher than your monthly payment plus your maintenance fees. That's what we call a cash flow positive. Then you can claim the 400,000 minus 300,000, the 10 times ROI is fully yours. If not, you have to deduct your monthly cash payment or the loan that you service, the maintenance fee. You have to deduct from it in order to claim the ROI. And just want to ask anyone here, including myself, I've never had invested in a positive cash flow property. That's probably because I just, the house that I bought is just for my own stay. But how many of you can easily identify a positive cash flow property? As I mentioned just now, we have a lot of developments coming up. Prices for properties in Johor is crazy now. And given the NAPIC data, the pricing has actually just rebounded not too long ago. And we have a lot of supply. So it's quite hard to find a positive cash flow company. Plus, they have a cashback that allows you to pay very minimal upfront. It's very, very hard. Okay. So just to see a show of hand, if anyone here has the uh cash flow positive property, if yes, you can comment a yes. If no, just like me, you can comment a no. Just want to see. Okay, but we'll move on to the next part. Then, in contrast, if you invest in a REIT, right, for that period of year, you still enjoy a 5 to 6% distribution yield. That's around the median of what is the return, sorry, what's the distribution yield that you get for investing in a Malaysian REIT, right? It's more public friendly, it's less capital intensive, and effectively, I would say is lower risk. And then if you look at the second part, okay, for the income distribution part, okay, income distribution for rental income, yes, is fully received by you, okay, and by contrast, REITs, they are required to distribute 90%. So basically what I'm trying to say is that you get the full control, but the problem is you have to service your loan. And now OPR just come down. We're going to talk a bit about OPR later on. But what if OPR goes up? Your cost of servicing the loan of that property would also increase. Next, and also your ownership, when you own a property, your mental toll increases. Why? Because you are prone to a lot of potential losses and unseen risks. So as I mentioned just now, the case study that I given is based on you have a very good tenant that pays you on time. You don't have the headache to chase for rental income every month. And also you have to guarantee that your tenant has to be grateful to not crash or destroy your property. And you also have to pay for the wear and tear and also the mental toll of managing that tenant, unless you get someone else to manage for you, which reduces your income. It's even harder to get positive cash flow in that sense. But in contrast, if you invest in REITs, then you have lesser the stress. That's why I say it's very suitable for people who are more laid back, more relaxed. Someone like me, I love dividend. So I just lay back. I enjoy the property manager managing the property for me, right? Although I don't own the property itself, I indirectly own a small part of it in the asset ownership column. I own a small part of it, but in terms of income distribution, I still get the benefits of it. And next one is the gearing ratio. Now, if your income bracket is not very high, okay, so someone asked whether on the tax part, if your income tax bracket is high, then you have to pay a higher tax in the rental income that you receive for the real estate that you own. But for REITs, you don't have to receive that. You don't have to pay that. Okay, it doesn't matter what your tax bracket because they're already deducted from the 10% withholding tax on that part already, right? And imagine if you want to grow your portfolio of properties, right? I need to keep borrowing money, which means my risk getting higher and higher and higher in the event there's a downturn of the property market. And how do I get more loan? Assuming my active income stay the same, which I declare more income from rental, right? When I own 5 properties, I declare rental income coming from 5 properties in order for me to get higher financing more for my subsequent properties, right? In that case, you have to keep gearing up. But in REIT, you don't have to gear up to invest in them. So they might have a gearing limit of 50%, but when it comes to investor level, it has nothing to do to you. Okay? Because you're just investing in a vehicle that are holding the assets. So your gearing risk for risk averse people, in this contrast, your risk will be lower. And then ultimately, it's the one that we mentioned just now, which is the liquidity. I think everyone understands this by now. For freehold properties, the quickest that you can get, assuming the land office is working 24 hours, 7 days, and 7 days per week, it takes you around 3 months for you to completely dispose the property, right? For people who have sell a property before you understand the hectic and also the time frame of it. And assuming there's a right buyer, right price, and the buyer is able to finance or pay for the property, right? You have all these criteria to meet up before you can sell off the property. For leasehold, all the best to you. It probably takes around 6 months or more. And for REITs, as mentioned just now, probably it just takes T plus 2 or T plus 3 working days. So it provides you with the liquidity. But nevertheless, I'm not saying which one particularly is better, but it depends on your risk appetite and also your targeted return on investment and what kind of investment personality are you personally. Do you have the time to actively look for potential deals in properties, or do not have the time? You prefer to spend the time with your family, you prefer to spend your time to doing whatever you're passionate at. If you are passionate at investing in stocks or investing in properties, so be it. But if not, liquidity is very important to you, right? And also um the less mental toll that you're investing in a REIT, that one is very, very important for me personally. Okay. Okay. Next I think we'll go to the types of REITs in Malaysia. Okay, we got a bit too technical in the last slide. Hopefully I don't confuse some of you. Okay. A bit too much number in the last slide. Again, if you have any question, please put into the Q&A box. Okay. Okay, so the first type of REIT that we probably gonna get is malls. We have a lot of malls in Malaysia. Probably a bit too much. And if you saw a news 2 years ago, it's actually been mentioning that there's a potential oversupply of malls over in Malaysia, right? I think the case is true. If you look at the number of new development malls, especially in Klang Valley. So what does mean for the REIT itself? It would mean when I have the mall as a property, which are my ingredients on my cake, when there are more ingredients of in the market, that means that people can choose. They have more freedom to choose, and there's a higher competition over that. Okay, so that's the one of the things that are going on with retail REITs recently. And what are other types of REIT that you are aware, but you probably think there are this kind of REIT over in Malaysia, right? I will give you a bit of time. Let me drink a bit of water. Feel free to comment at the comment box below. What other REIT type of REIT that you think exists over in Malaysia? Okay, I saw office, yes. I also see data center. We don't have a full-fledged data center REIT per se in Malaysia. They are in Singapore, okay, but in Malaysia, a full-fledged data center REIT in Malaysia, no. Okay, so some of you mentioned hospitality. This is a hospital REIT, hospital. So it's not exactly hospitality, right? But there exists like our Aka is a pure play healthcare REIT. And this is the office, industrial, and also hospitality. This one is actual hospitality, right? So for retail malls, right, you name it, Mid Valley, the Gardens, Pavilion, Sunway Pyramid, even Star Hill is listed as a REIT, just not in Malaysia. And we have office properties. Now, in my personal opinion, right, if you are a property investor or reinvestor, probably you need to think of the different working trends now, especially for Gen Z going forward. There are a lot of new businesses or startup is going for work from home trend, and also emergence of what I mentioned just now, emergence of different type of working patterns for newer generation. For example, the gig economy. You don't really need an office for that. But in contrast, for industrial REIT, which are the warehouse, factories, and everything, those are in demand. Okay. Um, and we have hospitality REIT, which I mentioned just now, YTL Hospitality, that is doing pure play hotel. So you have to, when you talk about hotel, it's very relevant to the tourism and very relevant to the economy that's going on in Malaysia. We also have mixed asset types, which means the REIT itself have multiple types of assets. Okay. Actually, there's also another REIT, not to say another REIT, another type of asset that is emerging currently, which is the educational assets, right? Which means the REIT itself, they own the asset to a campus. Usually, this type of asset, and also for healthcare, they have a very long tenancy period, which is good. They usually provide very good rental visibility, but also a bit boring because when they sign a 15, 20 years kind of lease term, right? Usually how many percent of rental reversion basically is a term to showcase the increase of rental, how many percent we increase. um Usually it will showcase quite clearly, so the upside surprise for that REIT itself is usually quite fixed already. Okay, so once again, I saw someone commented IGB commercial REIT. As I mentioned at the very beginning of the session, comment on a REIT that you personally like later on. The most commented one, I'll choose it and try to make a case study later on if we have the time later. Okay. Now, we're going to the second part. We're going a bit slow. Let me go a bit slightly quicker, right? Which is the macroeconomic factors that could be affecting REITs over in Malaysia. I think this is very important for new investors because you will understand or you will know that, oh, I saw this news, what it would mean for the REIT that I has invested in, right? This is quite important. Okay. Now, I know this slide is a bit I mean, a couple of days old. We just saw the new announcement by our government that saying that our Q2 is probably going to be very good. But factually, Q1 has been growing by 4.4%. Uh, of course, in the Q1, we are supported by dual festive season. If you look at Q1 back then, a lot of retail REIT, they are doing fantastic. And it's also a cyclical factor. Normally, in calendar year basis, which means not financial year, calendar year, Q1 and Q4, usually the REITs, retail REITs, they will do better because of the festive season. Q1, you have the Chinese New Year usually, and you also is touching or it's in Hari Raya. And for Q4, obviously you have the Christmas and also a lot of holiday. People have a lot of time to spend. Okay, so Q1 and Q4 usually it is better. Okay. Um, the GDP of a country, I think is quite important for potential growth for REIT, right? Unlike other different markets, let me give you an example. Unlike Singapore, unlike US market, these markets, their REITs, they have global asset allocation. Malaysia REITs, usually they focus on Malaysian assets only. So it's geographically more focused. But in another way round, if you want to gauge whether this REIT is performing well or they're not performing, just walk to the mall. Okay, I'll give you an example. IGB REIT, you want to know whether the REIT is doing good or not, just go to Mid Valley or just go to the Gardens Mall. You will understand whether the traffic or what we call footfall, is it good or is it bad, right? And if the economy is not doing good with higher tariff and people have lower spending power, I think it's quite obvious that spending power may decrease. Now, as mentioned just now, the REIT, some of the retail REIT, they actually have a revenue sharing with their tenants. So this one is very important. When the economy slows down, it will also slow down the growth or income earnings of some of the retail REIT. Okay. Now I think the consumption power and then the tourism is still quite good because of the higher Chinese visa fee visit for 90 days over in Malaysia. Okay. Now, OPR has also just went down 2.75%. For those who are new to economy, basically the interest rate went down for a bit. REIT, usually they have, as I mentioned just now, they have gearing. Whether they have fixed or they have floating, what does that mean? A fixed loan is just like your car loan. It doesn't matter whether the OPR went up or went down. Your installment will be fixed throughout the period. But for your housing loan, if you're taking a flexi or semi-flexi loan, OPR comes down, your housing loan can actually decrease. Okay, it actually decrease. So in that context, the interest expenses for some of the REITs will actually decrease. So OPR went down is a good thing for REITs itself. Okay. And next one is not exactly a pointer, but I just want to cultivate a bit of thinking and spark a bit more discussion amongst you guys. I know last two slide a bit technical, so I hope you're not falling asleep. Okay, I just want you to think with the increase of government serving income, which announced last year and also this year, minimum wages also increase, and spending power. There are some slight what we call sweetener just in announced above 18 years old. There are 22 million Malaysian expected to be benefited. Will you think this would increase the total spending power, or it will be dampened by the SST wider coverage and the electricity tariff, which we have adjustment, right? And there is also a potential inflation to come from tariff worldwide. Which one is most likely? Which one is more likely to happen? A slower growth ahead or a stronger domestic consumption ahead? Which one do you think? This is very important. If you expect the tariff to impact Malaysia greatly, so some of the warehouse REIT, their demand might be lower, their ability to fight for a better rental rate might be lower. But if you think the local market consumption power is there, people are still very strong in terms of spending power locally, then I would say that you can look into retail REIT. Okay, this is for discussion, so you can feel free to comment. Okay, Fitri has actually commented slower growth. I give you guys maybe 15 seconds to, think about it, and then you can discuss on this part. Okay, Chris commented SST, not sure what that means, but yeah, Julius commented positive growth. Sui Chen also commented stronger spending power. Okay, great. Okay, glad you all are more positive. Okay, not all are grim. Of course, if you look at in this year, if you look at the footfall, actually these are public data, by the way. You can actually go and check the what's called Malaysia Airport. Unfortunately, if it's gonna get delisted, then we have trouble getting the data, right? But now I think every month they're declaring the total footfall data in the airports. So far has been on quite increasing. Okay. Um and on that basis, you would say that the malls and also hospitality is probably gonna be good. Okay, so basically all these pointers here, none of them are permanent. These are things that could change tomorrow or maybe the day after tomorrow, depending on what new policies that comes in. Or touch wood, anything new that could happen, it will change immediately. So the session today, very important lesson here is to cultivate your thinking. How would a macro news impact my investment? It would helps you in deciding whether I want to run away now or I want to stay in my investment. Okay. Now, on a year-to-date basis, I think Malaysia REIT actually performed not bad. Well, what I mean year-to-date is from first day of 2025 until a couple days ago. This chart is taking a couple days ago. So far in terms of capital gain. Now, what we talk about just now, whatever we keep discussing is rental income distribution, which is dividend. The money goes directly to your pocket. But in terms of capital gain, which means you need to sell the REIT to retrieve the benefit or to get the profit, right? Recently, the Malaysia REIT are doing very well. Number one is probably inclusion of a new REIT, which is Paradigm REIT. And second is because the stellar performance of a particular REIT, IGB REIT. Okay. Maybe due to the acquisition of the South Key Mid Valley Mall, probably. And you can see that on an overall basis, it actually go up by 7% year-to-date basis. And if you analyze that, it's actually around 14%, which is quite not bad. This one is excluding your dividend gains, by the way. Okay, so this year with OPR coming down, I think it's a quite interesting timing to look at all these REITs as a whole. But of course, some of the REITs, I should say a lot of the REITs, their price has already gone up. Okay, so again, you have to gauge on that part. And next one, I think is very important uh, part of today's session, which is how do we analyze a REIT? I'm gonna try to go a bit faster on this part, and then we try to take one read on their quarterly report and what are things that we should see exactly. Okay. Now again, after what I talked so far, what do you think are the most important part of a REIT, particularly most important thing? For the whole piece of cake, what do you think is the most important thing? Right? What do you think? Okay, basically, the most important part Julius mentioned, property itself, some mentioned increasing dividends or distribution, profitability. Okay, basically all three are correct. But for me, one of the most important part, someone mentioned yield, tenancy, all these are important. For me, number one thing I will look at is asset quality. Okay, what do I mean by asset quality? Basically, it's the quality of the ingredients in the cake. So make sure it's not moldy lah, it's not too salty, it haven't gone bad in terms of the whole piece of cake. Otherwise, it would jeopardize the whole cake, right? So that is on the asset quality part. And how should we define them as an investor just started? Number one is that to look at their website or look at their annual report. What are their assets? So some of you, as a Malaysian, I'm sure we all go to malls often. So you will know that which mall is actually a lot of people, when which mall is actually underperforming. That's one way to gauge it, to look at their property individually. Second way is a more, I would say, rougher way, but very quick way, is to look at their Q4 results, which is the fourth quarter result. Usually, they will need to undergo revaluation. What do I mean by revaluation? It means that there's a valuer to look at the total assets that the REIT have, and then they reevaluate. Whether there's an increase or decrease, usually it would be reflected in their Q4. Now, coming from a valuer perspective, right? Do you think a valuer would increase the value of a property based on a couple of factors? I mean, positive factors. Higher cash flow generated. By comparison basis, their nearby properties prices has increased, or the estimated cost to build a completely new property, which is what they call cost approach, right? To build a similar asset as what the REIT has already have on their hands will be higher, and also the land value increase, etc., due to the nearby development. So all these factors, it will increase the price of a property. By right, a good REIT, if they have a good property, every year the property value should increase, unless otherwise there are some short-term impact. For example, like the COVID-19 times, a lot of property they see pricing actually came down. Okay. Usually it'll be reflected in Q4, unless they do it on Q2, which is very, very rare, right? In the fourth quarter, they would do a revaluation of their property. Just imagine your house, because of your property is in stronger demand, the rental rate that you could potentially get is getting higher and higher and higher and higher, right? So it will also increase the value of your residential property. I hope that explains in a simpler context, right? And some of you has mentioned correctly, which is the occupancy rate and also tenancy rate, right? A good property, usually they have high demand. Otherwise, people want it for what, right? When it has a high demand, high occupancy rate, what does that also mean? It also means that they have a strong negotiation power in renter, which leads to another indicator, more technical, fancy term. It's called rental reversion rate, triple R, right? You can type in triple R to remind yourself, right? But it's basically very simple. It's just a indicator to track whether the REIT, what's the adjustments of the rental rate this year compared to last year. If you increase as compared to last year, you have a positive RR, rental reversion rate. But if you decrease as compared to last year, your rental rate, last year per square feet maybe is 2 ringgit, right? This year you're doing 1 ringgit 80 cents, which means your property, the rental actually went down. Unless the economy is super bad, then otherwise, normally the rental reversion rate should be positive, because as you manage the property, as the property price generally over the long term, it has been going up, right? Although there's a slight drop, as I mentioned just now, based on NAPIC data on residential property. For commercial property and industrial property, so far, I would say if it's a good property, it would go up. Okay. So a good property, you will see a good RR. A bad property, very simple, negative RR. So you can actually look at their annual report. They would have to disclose this kind of information. Okay. And if you look at macroeconomic factors, like I mentioned just now, based on what we have been observing, there is an potential oversupply of malls over in Malaysia. What does that mean? Come again. I want you guys to think based on macro perspective. Oversupply of malls, higher competition, and you have more competition, your ability to negotiate a better rental rate will be lower, which means on sometimes you might not be able to raise your prices as good as last time. Last time, every year, people come to you, hey, please give me a shop lot. I want to do my business in your mall. But now, imagine just adjacent 5 kilometers away from you, there are three malls. So they can just go to other malls, newer malls that have probably lower rate because they are newer. Okay, in that sense, it doesn't mean that there's a sure success, but it reduces your competitiveness. This is one of the things that we could see over in Malaysia. So what does the reduce negotiation power on the rental rate leads to, which is another thing, which is the financial performance, as some of you rightly pointed out. So generally speaking, REITs itself, they are very regulated products where the risk of fraud case is extremely low. But as I say, there is never confirmed or sure thing over in the capital market. The only thing that is certain is uncertainty, right? So it's not 0%, but the financial numbers that they disclose is close to 99.99% certified is true. Okay, so it's very obvious that when you look at a financial report, you will know immediately whether they are performing well, like improving gross revenue. Well, usually when they have an improve in revenue, three things can only happen. Okay, number one, their occupancy rate increase, which means last time, my property, let's say an office block, we keep talking about retail malls. Let's talk about a warehouse. Okay, so let's say I have 6 warehouse. Last time, 5 of them fully rented out. Now I rented out my 6th one fully, so I have an increased occupancy rate on the overall level. Okay, so my revenue would increase because occupancy rate went up. Or I have a positive rental reversion rate, which means my property this year I increased my prices by 5%. By right, my revenue should also increase by 5%. Right? It's very straightforward. And another thing is that something more tricky, okay, which is related to acquisition. So a lot of times REITs is very common for them. You imagine if they are purely relying on occupancy rate and also rental reversion rate, the growth is actually very, very slow because every year it is almost impossible that you can maintain a double-digit growth for a REIT in terms of their rental reversion rate. Double-digit every year is quite impossible. Okay, unless it's coming up and down a bit, then it's more explainable. But usually it won't goes up to double digits so easily. Now, but when they acquire assets, they acquire, let's say, office, I acquire another office block. So my absolute number, my revenue, my net property income, NPI, and also the dividend or distributable income, if it increase, okay? Uh, but you have to be very careful in this because there are a couple of ways that they could go through to acquire properties. As I mentioned, just now, right? They can, number one, they can get bank loans from the bank, or they can choose to dilute, or that means that more people to share the cake, but the cake is larger. Okay, I will talk about how do we identify whether the acquisition is good or bad later on. Okay, and okay, financial performance, just like investing in a stock, if you invested in a stock before, growth is one of the most important factor. Okay, because if you don't invest, if you put your money in the bank, even though you're earning an FD of 2.5% or 3%, inflation eventually is going to erode your consumption power. So for REIT itself, it's very important that on a baseline basis, they are able to maintain a growth rate of 5 or 6% and beyond. Okay, that is very, very important. Okay, so now we're going to go into how do we identify whether the growth is justified or it's just because of acquisition. Now, when you have more people sharing the parcel of the cake, although it become larger, there's a if you look into any financial report now, you can see there are two key things. Number one is the earning per share. To simplify, I just call it EPS, earning per share, which means for each share of the company or each unit of the REIT, how much of the earnings that you are getting, okay, what we call EPS, and also DPU, distribution per unit. This is the dividend that you are getting every year. Now, if after the acquisition, after the dilution, the EPS and also the DPU still increases, that means the increase overall is still larger than the dilution. Okay, although more people are sharing the parcel of the cake, but the cake has become so large that everyone, in fact, got a larger pile of cake. This is a good acquisition scenario. So let me give you another example. If a REIT itself is giving out around 5%, 6% distribution yield every year, right? Assuming there's a dilution is involved, I think their acquisition should achieve 6 or 7% gross yield of the REIT itself. Normally in the disclosure document, they will mention to you what is the expected yield that we are expected to get from this property acquisition. Normally, I will look at 6 to 7% RI or gross yield that would usually justify the dilution, which means even after dilution, for this is good for the unit holders, which give you a positive return. But sometimes this kind of thing can only be observed on post acquisition. What does that mean? During or before the acquisition, just like us showing your report card to your parents, you try to make it very nicely. But after showing, your performance might drop. This is true in some of the acquisition cases. That's why at the very beginning, I've mentioned the sponsor is very, very important. Because if the asset owner, the person that managing the asset doesn't change hand, then it means that even after the acquisition, it's likely that the property will maintain the performance. The likelihood is larger in that sense. Okay. So in the case of dilution, it's very important to look at the post-dilution or post-acquisition EPS or DPU changes, or you can observe their historical acquisition. Are they acquiring some funny assets and then their DPU actually went down? There are REITs in Malaysia that actually uh, does that. So you have to be very, very careful on that. Okay. Now I know you guys have a couple of questions here. I'll try to answer it. Bear with me. We have a couple more slides to go. I think this is very, very important that I have to really go through, which is the valuation. Now, for more savvy investors out there, for if you have experience in the stock market, what do you think is an appropriate valuation method for REIT? How would you value a REIT? Based on what? Okay, you can comment below. What do you think is the metric that we need to use to value a REIT itself? Okay, Faizu, location is a good answer because you need to look at the location of the property to determine the asset value, which leads to some of the answer here, which is the price to book. Okay, we're gonna talk about price to book and yield this part. Okay, which is price to book. In simpler way, it means that if the asset on book, which means on surface value, the asset is value of 1 ringgit, for example, 1 ringgit. So you are paying, let's say the price to book value, you're paying 60 cents of it for the 1 ringgit worth of property, which means your price to book value is 0.6 times. You're paying lower, okay? You're paying lesser to get a higher value asset. But is that always good? Okay, usually what we see is 1 ringgit by 1 ringgit is fairly value, quote unquote fairly value. But when it's fairly value, usually it would means that there are no excitement. There's limited upside. There's limited growth for that REIT itself. You see, Malaysian market is not perfectly efficient, or any market is not never perfectly efficient, but it's still efficient in somewhat. If there's excitement, there are growth potential, there are some stories to the REIT itself, then you could see that the valuation is usually higher. That's also true for a lot of stocks. Because NTA is a bit tricky, or price to book value, some of the assets they might appear undervalued. Okay, let's say when I mentioned just now, this property is 1 million. Imagine a residential property, your bungalow is worth 1.5 million, right? And someone is offering you to buy at, let's say, 750,000, which means your price to book value is 0.5 times. So you might think, what is wrong with this property that you're selling to me so cheap? Is it haunted? Is there something wrong that's going on with the property? So you might think, right? So the price to book value actually, again, there are some cases that price to book value is lower in that sense. Okay. And this kind of REIT, they could be having a very slow, or their assets are underperforming. That's why the market is giving a discount onto the valuation, or even negative growth. There are REITs like that. So you have to be careful when you are evaluating a particular REIT just based on their price to book value or based on their properties. And if you look at a highly sought after REIT, such as the IGB REIT, for those who do not know, IGB REIT is the REIT that owns the Mid Valley and Mega Mall and Mid Valley and the Garden, sorry, and also soon the South Key, right? They could go up to 1 times of price to book value, which what we call overvalue when it goes more than 1 times, right? Just give a wild guess. What is the price to book value of IGB right now? Okay, a wild guess. The number I just looked at it today is actually surprised me by a lot. The price to book value now, if I'm not mistaken, is trading at 2.34 times, which means again the same bungalow, right? 1.5 million. Now you have to pay close to 3.6 million to acquire the bungalow. So imagine this kind of valuation. Why? Is it a lot of people chasing after this bungalow? Is there a lot of people are looking after to buy? Maybe because next to you, maybe some Tan Sri is staying there or some princess is staying next to you, whatever reason. Okay, so it's not the perfect method, or you cannot rely on one single valuation or just buy a REIT just because the valuation, the NTA is high and your price to book value is low. This is what we call value trap. Be careful. But if you look at a dividend yield, or even better, if you could track the historical dividend yield of a particular REIT, right? Remember, yield is the net amount that you get. For example, if I get 10 cent out of a 1 ringgit investment, my yield is 10%. Sorry, excuse me. Okay, right? This is what we get yield. If you look at the yield, you also have to look at another thing, which is the DPU, distribution per unit, which is the annual piece of cake you get to buy after you share the piece of cake with other people, right? The dividend that you get every year. So yeah, imagine that if you're buying into REIT, chances are the share price will remain flattish. It's quite likely that this is the case usually. But you will still get a yield of maybe again 5 to 6%, and you spotted a yield of 7% of that particular REIT. Now, if you are able to look back on the historical yield of that REIT itself, usually they are trading at 5% or 6% yield, suddenly becomes 7%. If this is because the uh, improved performance of the REIT itself, then they are giving you higher distribution, then it's good. It's definitely a good sign. And 7% yield, I think, is quite attractive for a lot of REIT, right? As a rule of thumb, I look at REITs for more than 6% or more, because you still have the 10% withholding tax again, right? But if you spot a 7%, does that also mean an immediate buy? You have to look at a couple of things. Number one, is it increasing in distribution per unit? If it's increasing in distribution per unit, it's unlikely that the REIT itself is performing badly. Why? Because they are already distributing 90% of their distributable income every year. So it's unlikely that they are able to finance and then pay you more. It's not like stocks. Stocks, they can do that. There's one case of a stock that has went down from 30 something ringgit to now, I think five or six ringgit, but the dividend yield is 7 to 8%, or even 9-10%, right? But in REIT, it's very hard to do that. Okay, so you have to look, as I mentioned just now, yield is something between the distribution that you get and also the share price. When the yield increases, which represent a potential opportunity, you can look at what has happened to the REIT itself, whether it's a temporary negative news. Again, as I mentioned just now, macroeconomic factors. For example, Trump has some new policies that comes out that hamper the whole market, rendering the whole market become very weak. There are the chances of that it lower the share price, which increases the yield on the surface of a particular REIT. Okay, but as a rule of thumb, right, the higher the growth of a REIT, is likely that they have higher than 1 times price to book value and also a lower dividend yield, lower than 5%, even that's also possible. So how do you value a REIT exactly? You can find your own metric, but for me, I will start studying if a REIT has a 6% dividend yield, And EPS, DPU has been improving. And also, you have to look at their history, which is the uh, last slide that we'll go through before I go to case study and also Q&A. You have to look after their potential red flags in REITs. Okay, so what are some of the red flags do you think that could potentially in the REITs? Okay, what are the potential red flags? Generally, if you see the share price of a REIT go down continuously, it's not about short term, it has been coming down for 1 year or 2 year, and there's an existing major or substantial shareholder that has been selling non-stop, chances are there's already a major red flag, or their internal management is keep changing. This is true for stocks as well. This is already a bad sign. Okay. Or another potential red flag is when a REIT is acquiring some of the assets that doesn't make sense at all. I give you an example. I'm managing malls previously, and I tell you that suddenly I want to manage a hotel. Next question you will ask is probably who will be managing the hotels? Again, if the same sponsor, right, they have the expertise, they have the management that previously managed the hotel before, then I think it's acceptable. But coming from a different background, let's say I have been doing retail my whole life, my doing shopping malls my whole life. Suddenly I'm buying into malls that I've never managed before. What do you think would happen? Unless they appoint an external manager to manage the properties, otherwise it's risky for investor in that sense. So you have to be very careful in assessing what kind of assets that the REIT itself is purchasing in that sense, right? And lastly, and most obviously, as I mentioned just now, the financial performance part. If they are constantly doing bad in terms of EPS and also DPU, their earnings are constantly coming down, not only in 1 quarter, not seasonally impact, but has been 1 or 2 financial year doing that. Probably you need to, assess the REIT itself, and if it's really something bad, then you probably need to stay away from it. It's also a sign of red flag that number one, whether there's something wrong with the asset qualities, as we mentioned just now, that you couldn't register a growth, it has been doing bad and bad and bad, or there's something wrong with the management itself. Okay, we have less than 20 REITs that are listed in Malaysia. So, if you are interested in receiving passive income and becoming a what we call backseat landlord, okay, that are enjoying this kind of distribution, right? I think you could start exploring REIT as a start, because this is not something like ultra complex that you couldn't comprehend. It's relatively lower risk when compared to some of the growth stocks. And also, this could give you an interesting recurring income. And most importantly, if you are fresh to investment, as I mentioned very early, you could even start with 100 or 200 ringgit. You can kickstart your investment journey already. Okay, that would be my. Okay, this is the last slide. Pardon me. 1 minute. Okay, so over in the session today, I think everyone here, you already know what exactly are REITs. What are types of REITs in Malaysia? We have retail, we have hospitality, we have industrial, we have healthcare, we have the office REITs. We also have mixed. Okay, we have different kinds of assets over in the market. Okay. And also, most importantly, I'm not telling you, because the macroeconomy is never permanent. The factors are never permanent. Tomorrow, a new news could come out and a new factor could come out. You have to assess it on your own, whether how would this impact on the REIT that I'm investing into. Give you an example. If tomorrow another rate cut, hopefully that will happen. Another rate cut by the bank, by the OPR, is even better for the REIT itself. So now you saw the news, you already know what this means for the REIT itself. Okay. And some of the important metrics I mentioned just now. Look at the occupancy rate. Uh, Sorry, didn't really go too deep on occupancy rate, but I go on another layer, which is the rental reversion. It's already reflected the occupancy rate, because if you don't have a good occupancy rate, chances are you couldn't negotiate a good rental reversion, right? and also the financial performance in terms of earnings and also the distribution and also their historical acquisition, whether it's good or bad in that context. Okay, I don't think we have time for case study because we have a lot of Q&A here. Apologies for that. Maybe Atira, I'll pass you back for the Q&A session.
Okay, thank you, Mr. Max, for your invaluable insight and wonderful sharing with us earlier. We will now proceed for the Q&A sessions. So can I share the slide?
Oh, sure. Sorry.
Okay, thank you. So I will start with the first question is it the good time to invest in rate as many of the stock have gone up?
Okay, I wouldn't really time the market per se. Okay. For those of you that have questions, just give me a minute, Atira.
Okay,
For those
okay.
of you who have additional questions that I couldn't answer here,
Mhm,
or someone that want to understand the case study, maybe you guys can reach out to me through the email afterwards. I think I have my email. So you can
mhm.
reach out to me. I try to come up with a simple case study, right? And back to Atira's question, whether it's a good time to invest in REITs, given the stocks are down. Now, I'm not sure which market you're referring to, but if you're referring to the Malaysia market, I don't think stocks particularly went down that much. Some of the stocks had already rebounded, right? And I don't think you should compare apple to orange in the context of comparing a REIT to stocks because the objective is very different. Unless otherwise you're going for yield, right? You're comparing a bank with a REIT, then I think it's somewhat negatively correlated because OPR went down. It's short term not so good for the bank, but it's good for the REIT itself, right? So it depends on your own what is the objective of you looking after a REIT. For example, if you are looking for oh, sorry, your question has gone up. Okay, anyway, REIT itself is a defensive vehicle. If you feel like the market is there are some chances of it slowing down, then you can look into some of the more defensive REIT. Now, last time, I would like to look into not recommendation, but just my experience. Last time, I would look into KIP REIT. Why? Because their asset mix are usually more defensive. If you look into their asset portfolio last time, it consists of KIP malls. And the consumer or maybe the tenants for KIP malls are usually the more staple things that you need in life day in, day out. So whether the market is good or bad, whether the spending power is high or low, these are the things that you still need to consume. So my risk is relatively lower. But of course, in better times, they have a better negotiation power. Again, the rental reversion rate could be better at the time. If you think that the stocks a lot has been gone up and you want to switch to REIT, I would say that it depends on really depends on your objective. If you're going for you play, I think you could explore, but just solely because the stock has gone up, without assessing which stock itself, whether the valuation has been overvalued, I think it's a bit hard to go too deep into that.
Okay. We'll go to the next question is rate dividend is fully exempted from dividend tax 2%. Cause rates have tax and non-tax amount.
Okay, this question, sorry, I mentioned 200,000 just now, but actually it's 100,000. Based on my last checking after the withholding tax, if I'm not mistaken, there are some vehicles that including your, I think PRS and your some of the dividend items is exempted. If I'm not mistaken, REIT are exempted. But if you want to double confirm, you can check with your tax agent. I would recommend to check with a professional tax agent on that. Yeah, I think
Okay.
EPF,
Mhm.
Armed Force Fund, Amanah Saham, and Unit Trust, and I think closed end fund, some of it as well. Uh, pretty at the moment, I think I need to double check and tell you guys.
Okay. You want me to proceed for the next question?
Yeah, I think we can take one more.
Okay. Okay. Uh, is it better to invest in high dividend stocks or REITs?
Okay, high dividend stock. Okay, this is again, it's quite similar to question that Lenny has asked, okay, is a bit hard to determine in that because stock itself, when they have a higher dividend yield, it could means that they have a one-off item. For example, they just sold a piece of land that they could distribute extra dividend to you, right? So you have to assess whether the dividend is sustainable. It's unlike REIT. REIT usually is more sustainable, but so stocks, they could adjust. They don't have the 90% rule, right? So they can adjust the dividend payout ratio as they wish. So you have to be a bit careful on that unless they have a very fixed dividend policy and very consistent throughout the period. And I wouldn't say it is better to invest in high dividend stocks or REITs. I think if your objective is getting cash flow, um, ultimately, I would say both are viable options in that sense.
Okay, it will be the last question that I will read. Uh, Many REITs companies paying the managers by issuing new shares to them. What is the max threshold that REITs could issue new shares to the managers? Can REITs do this every year continuously?
Yep. I think it's one way to reduce the cash flow constraint over to the rate. I do not have the exact figure on the payment, but usually not a lot, right? Usually it's only in 0 point something percent in terms of the distribution, and only when the REIT is performing. You can check that they have a management fee, maybe of 0.5%, etc. Right? They usually have a threshold on how much that they earn. And also during some times, such as acquisition or disposal, they also can get an extra out of it. So I think you need to check on that. But usually there's not a very hard threshold on the payout to them. But usually it's not very substantial, 0 point something percent. I think it's reasonable. Just imagine that if they pay them in cash, then you will receive a lesser distribution. So I think it's a give and take kind of thing.
Okay, I think that is our last question that we read. So we would like to sincerely thank Mr. Max Tan for taking the time to respond to the question asked.